Good morning. Welcome to Stock Market Today. It's Thursday, December 17th, 2020, and I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to ChaikinAnalytics.com/today. Sign up for a free email where I get a lot of the content for this show. We also give you daily stock ideas to consider that hits your inbox every trading day before the market opens. So U.S. equities finished mixed on Wednesday after the FOMC meeting and press conference. Fed is likely to remain accommodative through 2023, despite revising growth forecasts to the upside and unemployment to the downside for the next 2 years. Discretionary REITs and tech were the best performers. Industrials, energy, and healthcare lagged the broader tape. Treasuries were unchanged to a bit weaker at the back end of the curve. The dollar was weaker on the major crosses once again. Gold finished up 20 basis points after gaining 1.3% on Tuesday. WTI crude settled up 40 basis points after a larger than expected inventory draw. As we get to the desk this morning, S&P futures are up 50 basis points after Asian markets were mostly higher overnight, with Australia and China both up over 1%. South Korea and Taiwan were your laggards. European markets are mostly higher. Treasuries are a little changed across the curve. Dollar is weaker again on the major crosses, and the dollar index is down over 1% on the week. Gold is up 1.2%. Crude oil is up 60 basis points to kick us off on a snowy Thursday morning here in the Northeast. That starts out with the technical structure of the trends for the major markets unchanged, remaining in place. It was a bit of a mixed session yesterday. But the bigger picture trend is broadly unchanged and to the upside. Most compelling, in my opinion, the fact that the Qs have held the breakout level at 300. I think you can start thinking about 340 to the upside should that 300 level continue to hold. SPY has support at 360. Then 340. For the Qs, 260 is the key support. 300 is important in the near term. And the reason I say 300 is important in the near term is, as we alluded to yesterday, holding above that would mean that this is not a false breakout through the September highs. Remember, we had been consolidating for about 3 months, broke topside, gave some back, and then we're looking for 300 to hold. And so far, that has remained the case. IWM, nothing changed here. Probably still the best game in town. Support near 170, then 160 below that. Above 340 on the SPY, we see potential for 413 to the upside. That view is unchanged here in the near term as our roadmap and our playbook continue to play out into the end of the year. And remember, this is the final full week of trading for 2020. Next week, the Christmas holiday falls on Friday, and the week after that, New Year's Day is on Friday as well. So we'll have 2 holiday shortened weeks in a row. So just something to keep in mind from a volume and liquidity standpoint. Taking a look at the market in a minute now, what are we writing about today in our note for clients? Well, it's a mixed session as the Fed leaves policy unchanged. I think the Fed's message, though, was dovish, considering they took up growth forecasts for GDP for the next 2 years and lowered unemployment forecasts for the next 2 years, but said that they're going to remain accommodative. So better growth, better employment, continue to remain accommodative. You can read between the lines and call that dovish, in my opinion. Breadth remains constructive for equity bulls. Tech makes a new closing high. We'll take a look at the XLK a little bit later on in the show. Dollar breakdown continues. New 52-week lows for the dollar. We'll take a look at the dollar index. And as I said, futures point to a higher open here today. You can see the mixed session for the major indices. We'll chat about the power bars here in just a moment. The Dow lost 16 basis points, 5-2 bulls to bears there. S&P slightly higher, 13 basis points to the good, 131 to 42 bulls to bears. NASDAQ, your outperformer, up 55 basis points, 16 to 8 bulls to bears, back to a 2-to-1 ratio there. Still solid from a ratio standpoint for the small caps after losing 42 basis points yesterday. Call it 824 to 123 bulls to bears. Bonds down tick, sending yields higher. According to the Chaikin Power Bar, small cap stocks and large cap stocks are strongly bullish. Let's stick with our Thursday theme. Tuesdays, we run a screen of bullish ideas. Thursdays, we'll run a screen of potentially bearish ideas. And this week's screen is playing off of momentum at the sector level, similar to what we did to the upside on Tuesday, We're going to look at it here to the downside. Over the past month, there are 4 sectors that have underperformed the S&P 500. Those are staples, REITs, utilities, and healthcare. And now what's interesting is, with the exception of healthcare, for the most part, these are broadly defensive groups, right? So if you're bullish on the equity market, you don't want to see the defensive groups leading, and they're not, right? Over the past month, at least, they aren't. Healthcare is kind of a little bit more of a big mixed bag. It's got some defensive properties, but certainly has some risk-seeking areas as well. But so we'll take these 4 sectors and use them as a starting universe to look for stocks that have a neutral, minus, or worse rating. So neutral, minus, bearish, or very bearish. And then names with weak money flow and weak relative strength yields us 23 stocks that we either want to avoid or use as a source of funds. If you trade to the downside, there may be some compelling opportunities here within these lagging names. And you can see some names that stand out as being a little bit more high profile. Names like Pfizer, names like Edwards in the healthcare space, Avalon Bay in the REITs, Walmart, and Church and Dwight in the staple space. Kind of interesting that the tower / tech REITs like Digital Realty, SBAC are lower over the past month, or kind of not performing well, but that is the case. So 23 names here that I think could be a source of funds, or certainly at the very least probably want to avoid, right? There's so much working in the market. I don't think it makes a ton of sense to be focusing on ideas that are underperforming. So this is the screen that we're featuring here today. It's featured in my note as well for those of you who are Chaikin clients, as well as those of you who are taking the 14-day trial. You'll read more about it there. Taking a look at the sector tracker now, movement of the last 5 days. There's tech going back to the top of the list, discretionary comms. That's the board you want to see as far as the top 3 are concerned. Right? For 3 months, these leading groups, or what had been leading groups, kind of went nowhere. Are they reasserting? I don't know. It looks like early days, but think about what that means from a bullish perspective potentially for the market. REITs round out the top 4, also higher over the last 5 days of trading. Utilities, fins, and energy are in the middle of the road. Staples, healthcare, materials, and industrials are at the bottom of the list, as materials and industrials seeing a little bit of profit taking here in the near term. Turning now to our industry in focus. We've talked about it for the past few months. Highlighted the fact that the banks have been coming on. So our industry in focus today, auto-generated, and then I'll take a look at it for you here in real time, is regional bank services, which over the past 6 months has been a leader, outperforming the S&P by 8.5%. Power bar ratio is very strong, 83 bulls, only 1 bear. It's currently ranked number 8 of 21 subsectors, having moved down 2 slots over the past week. QCR Holdings, QCRH, Hilltop Holdings, HTH, and Independent Bank Corp, IBCP, all have very bullish ratings as holdings of a fund that has a compelling structure. I would just say we're kind of overbought here in the near term, but let's break it down. Very bullish ETF rating, strong trend above our rising long-term trend line. Personality change back in November, goes from being a big underperformer to starting to outperform, with the intensity of outperformance picking up of late. Chaikin money flow is bullish. Here's the overbought reading, right? So you just kind of want to keep that in mind. Do have the breakout through that interim high in June. That's a pretty compelling setup as far as I am concerned. And just kind of an area of the market that looks interesting. What's kind of driving this away from the technicals? I think it's the backup in rates, and in particular, the steepening of the yield curve that's been playing out over the past few months. So KRE, I have long exposure personally. It's a group that we've been talking about. We've been highlighting some banks in our notes, and I think it just kind of looks compelling here in the near term, but for the overbought condition. Let's take a look at yesterday's movers and shakers, our gainers and losers. Chipotle caught an upgrade at Stifel. Would also note that it broke the stock out somewhat from a technical pattern. CMG up 4% yesterday. PayPal, Stevens took their price target up on PayPal, added 3.8% on the day. ServiceNow hit a 52-week high. NOW up 3.3%. No news on Estee Lauder. EL up 3.3% on the day. Same goes for KMX, higher by a little over 3%, though I didn't see anything company specific to drive trading there. On the loser side of the board, Dish Networks came into the day with a bullish rating. However, it lost 11.7% as they announced a $2 billion convertible offering. TSN, we mentioned it yesterday, downgraded at JP Morgan, weighed on the stock, down 4.4% on the day. STE, this has actually been one that I've liked. Didn't see any company specific news. It did lose 3.4% on the day yesterday. MTD, Mettler Toledo, bullish rating, but news that the CEO was stepping down took 3.3% out of the stock. Holly Frontier just down with the energy names, giving a little bit back. Neutral rating here at Chaikin Analytics, down 3.3% on the day. Didn't see any company specific news to drive that movement to the downside yesterday. Let's dive into the charts. Thursdays, we do breadth, and breadth remains constructive across time frames. Taking a look at the percentage of stocks in the S&P that are above their 200-day moving average, holding at 91%. That is a solid percentage. That is 5-year highs, folks. Can it be a little too much of a good thing? Maybe, but we let the roadmap dictate views and positioning. S&P 500 percent above their 50-day, still above 80%. The percentage of stocks above their 20-day has ticked in a little bit. It's now slightly below 60%, but all in all, the breadth picture remains constructive for equity bulls. Take a look at the advanced decline line holding above the breakout level. So, looking at different measurements of breadth, looking across timeframes, looking at something like the RSP, the equal weight S&P outperforming, right, speaks to the fact that smaller names are doing well. We've talked about it. We've pounded this table for a while now. Not going to kind of beat the horse here, but just breadth does remain constructive if you are bullish the equity market. So until that dynamic changes, kind of hard to change the view in the near term. Let's take a look now at technology. So this is what's interesting to me, is that tech had gone nowhere. Remember those highs in early September and then the consolidation. And, there are other groups that look like this. Comm Services recently breaking out, but had gone nowhere. The growth over value ratio peaked around this time frame as well. But now we're seeing tech break top side. Had a new closing high yesterday above those early September highs. All the while, the RSI never became oversold during the consolidation and is holding bullish ranges. So if we think about what that means for the market, this is the largest weight in the market. So the market was able to hold up and actually work higher as tech went sideways on an absolute basis, and actually was a slight laggard on a relative basis. If tech gets in gear as the biggest weight in the market, stands to reason that that's a bullish data point. And as we look at tech relative to the S&P 500, what we can see is a near-term breaking of the downtrend line from those September highs. Now, ideally, we'd love to see tech break out on a relative basis as well to coincide with the breakout on an absolute basis. But for all intents and purposes, I would argue that this is a bullish development. XLK trading above the rising 50-day moving average, above the rising 200-day moving average, and the trend is confirmed by momentum by looking at the RSI. So that's fairly compelling if you're an equity bull, especially if those other themes continue to play out, small caps, value, etc. And then finally, the dollar breaking down. Here's the dollar index. We've looked at this before. You can see the consolidation. The consolidation resolves to the downside. There's been an inverse correlation between the dollar and risk assets since the dollar peaked in March, coinciding with the low in the equity market, and it has trended down ever since, below a 50-day, below the 200-day. RSI confirming the trend to the downside as it is solidly in bullish ranges. A little bit oversold here in the near term, but you get the point. Inverse correlation. So as the dollar is breaking down, that's a bullish data point for risk assets, supports our view of higher for equity markets. That's going to wrap us up for today, Thursday. Have a great day, everyone. Take us for a test drive, chaikinanalytics.com/test drive.